All right, the closing bell just rang on what can only be described as a battle of attrition.
Total battle.
You have institutions just looking to lock in their gains against this incredibly thin holiday tape. So let's get right to it. Give us the final scorecard, hot off the presses.
Straight into the numbers. And look, the picture is decidedly mixed. It really reflects the day's, total lack of conviction.
Right.
The S&P 500, the benchmark, it basically closed flat, squeezed out a tiny gain of 0.08%.
Barely green.
Barely. And the growth engine, the Nasdaq Composite, it actually slipped backward, down 0.12%. The only real strength today was in the Dow, which outperformed, gaining 0.22%.
So a flat S&P really doesn't tell the story for you, the active trader. We were calling this a choppy mess all afternoon, and that's exactly what we got.
A highly rotational session.
This wasn't some sustainable breakout, and thankfully it wasn't a major head fake into the year end either. It was just low conviction squaring of books.
That's the perfect way to put it. The dynamic here is a collision of these, powerful but temporary forces. You have the year-end institutional window dressing.
Making the portfolios look good for the report cards.
Exactly. And that's running straight into holiday-thinned liquidity. So what you get is sentiment that's just locked firmly in neutral because, conviction is totally absent.
Nobody wants to add risk for 2 days when they're sitting on, a 17% plus year for the S&P?
Not a chance. You don't jeopardize that return. It is a classic wait-and-see tape, but a very vulnerable one.
And you could see that defensive posture reflected so clearly in the sector rotation. I mean, when the market is scared or just satisfied, where's the money go?
Today it was utilities. Clear leaders.
A textbook defensive yield rotation.
Yeah.
It's a big signal that people are moving into stable, low volatility sector. They want that dividend.
Absolutely. When the market is fatigued by valuation, money seeks safety. And utilities are the polar opposite of risk-on growth. So conversely, the obvious laggards were in tech.
Specifically those high duration names getting hit with aggressive profit taking.
Right. And just to unpack that term, we're talking about companies whose valuation is just so heavily reliant on future growth.
Way out in the future. High multiple tech.
Exactly. So when rates or earnings are in question, or you're staring down a tax calendar flip, these are the first stocks that managers sell to lock in those, spectacular 2025 gains.
So it's tax motivated and defensive, not conviction.
Precisely.
Okay, it makes perfect sense. So let's strip away the headlines. Let's look at the internal data, the quantitative reality. Did the real money, the institutions, actually buy this close?
The volume verification is essential here, and the answer is a pretty resounding no. Monday's volume was simply anemic.
How anemic are we talking?
Total shares traded hit just 13.08 billion.
1308. So that's what, trailing the 20-day average of 16.2 billion by nearly 40%.
Nearly 40%. It's a critical data point. We're calling this the empty room signal, or maybe the Santa stall.
The empty room. I like that. Because it means small orders have this outsized impact on the tape.
Exactly. You, the active trader, you have to recognize this movement is deceptive. You cannot chase these headline numbers when the accumulation is this thin.
And what's really critical is that institutional intent. They were so clearly fading the rally. The S&P tagged an intraday all-time high early, but the closing print,
the final hour,
it just showed this definitive pivot to profit-taking. They used that high to get out, not to get in.
Big money is just rebalancing. They're locking in the year, and they are not looking to add risk at these multiples with 1 day left. We saw consistent, heavy sell-side pressure in semis and large-cap tech. Think Nvidia, Broadcom, all afternoon.
And you expect the MOC imbalances to stay skewed to the sell side tomorrow?
I do.
Hold on. For those not living on the options desk, what exactly does a sell-side skewed MOC market on close? What does that mean in practice?
It's just the final auction that sets the closing price. So when we say it's sell-side skewed, it just means institutions have placed way more orders to sell than to buy at that closing price.
Which forces the index lower in the final seconds.
Correct. It just confirms institutions are taking chips off the table. They want less exposure going into the calendar flip.
Now, here's the key takeaway. I think this should concern everyone looking at the S&P near 6,932. The headline numbers are lying. They are lying about the underlying market strength.
Oh, absolutely. We are seeing profound internal decay.
You have to look in the engine room to find it.
Decidedly so. I mean, look at market breadth, which measures how many stocks are actually participating. It was terrible.
The AD ratio.
The advanced decline ratio was just decidedly negative, both NYSE and Nasdaq. Decliners were outrunning advancers by a huge margin. It's basically saying for every one stock going up, two or more were going down.
So the rally is narrowing. Dangerously.
Which supports your point about the window dressing effect. Managers are rotating out of the crowded AI winners, your Nvidias, your Teslas, and into safer names.
The danger is that this isn't a broad-based rally anymore. It is a high-wire act propped up by a handful of megacaps.
The risk is that selective distribution is happening under the surface. Mid-caps and small caps are already pricing in a cooling labor market for Q1 2026. The easy money phase is over.
And this thin, tired tape provided the perfect setup for some spectacular textbook fades in the more speculative areas.
Institutions use that liquidity vacuum to just crush the hype trades.
Let's talk about that hype liquidation, because some of these reversals were stunning. Take silver XAG.
The ultimate bull trap.
It surged toward $84 overnight on social media hype, futures buying, and then it plunged a brutal 13% to close back in the mid-60s.
That parabolic move is definitively broken. Any dead cat bounce tomorrow is just going to get sold into by people trying to get flat.
And we saw similar retail exhaustion in the American Bitcoin Nasdaq debut, ABTC.
A massive reversal. It opened up 85% at $14.
Incredible.
And then just got slammed back to a $7.28 close. That opening liquidity, which was all retail, was just used by bigger players to exit, not to enter.
It shows you the quality of the buying interest right now is extremely low.
Even Nvidia, right? The stock with the biggest halo effect all year. It opened strong, but finished down 1.2%.
You can't ignore that. If Nvidia, the bellwether for the whole AI narrative, can't hold its key levels, the broader Nasdaq is just going to follow it down.
The tech narrative is losing strength fast. And this all raises the critical question of technical warnings. We have a massive divergence alert flashing.
Between the major averages.
Yes, and this is highly significant for the Q1 outlook. The S&P, because of those few megacaps, hit a new high on December 24th. But the Nasdaq Composite, it has fundamentally failed to make a new high since October.
And that is the classic technical split we dread. It just signals the growth engine is functionally tired.
Precisely. If we look at the momentum oscillators, the RSI and the MACD, they're both forming lower highs while the index price is near its peak. This is a classic bearish divergence.
And when the Nasdaq lags the S&P into year-end like this, what does it usually mean for January?
It usually means the broader market struggles to find any forward momentum. It indicates the strength at the index level is synthetic. It's driven by weighting, not by broad participation.
And crucially, volatility is waking up. The complacency is ending.
Volatility is definitely being repriced. The VIX, the market sphere gauge, spiked 4.4% to 14.20, and now it's hovering near 14.50.
So that breaks the sub-13 complacency regime we've been in for weeks.
It does. Traders are being forced to buy protection, and that tells you institutions are anticipating bigger swings tomorrow.
What are the catalysts?
Well, you have the persistent geopolitical flare-ups, specifically Taiwan's live fire drills, and then you have anxiety ahead of the 2.0 p.m. Fed minutes release.
So if the VIX breaks 15 today, that's the institutional threshold, right?
Yeah. That's the one. If it breaks 15, the Santa rally officially transitions into a January hedge. That's the signal that institutional selling will likely continue into 2026.
Okay, so given these technical warnings, the empty room liquidity pivoting to the actionable setup for the final trading day is, well, it's critical.
We have to respect the potential for an outsized move.
Let's talk about the game plan for tomorrow. Given all these signals, the asymmetric trade here has to be the 6-9 hand pin fade.
So you're looking at short-dated SPX call credit spreads above 6,915, or just buying volatility if that key support at 6,880 breaks.
Exactly. But wait, before we dive into options, let's clarify, what exactly is the gamma wall and how does it create this pinning effect that makes 6,910 so important?
Great point. The market is basically paralyzed by the 6,910 gamma wall. So 6,910 on the SPX or 691 on the SPY ETF is the level where the dealers who sell options have the most exposure. Total net gamma exposure is highest right there.
And because of that massive exposure, they are heavily incentivized to hold the index below that level.
They do that by selling into any move up that tries to breach that ceiling. It creates this aggressive overhead supply that, without any real volume, is probably unbreachable tomorrow.
So that's the ceiling. What about the must-hold support that protects this December uptrend.
That sits right at 6,880. That is the key trend line from the December lows. This level absolutely must hold if the bulls want to maintain any control.
And the danger zone, where selling accelerates.
If we drop below 6,878, just under that trend line, gamma flips negative. That is the danger zone.
Because dealers are forced to chase the delta.
They're forced to sell heavily to re-hedge. And that negative gamma trigger can accelerate selling really fast toward that 6,850 price magnet.
But we have to acknowledge not everything is fading. There are some day 2 setups showing relative strength. Look at Meta.
Meta, yeah. Closed up 1.3% against a red tape after acquiring that AI startup Manus. That's massive relative strength.
If it clears today's high of 642, the path to 660 is wide open. That's a strong, bullish continuation play.
And don't forget Intel. We're calling it the Nvidia tail trade. INTC was up 2% today on news that Nvidia completed its $5 billion stake purchase.
Right, a high-volume reversal right off its 50-day moving average. That showed real buying interest.
So you look for a momentum move toward 52.50 if it holds that 49.80 support on the open tomorrow.
Okay, so what does this all mean for you, the strategic listener, heading into the final day of 2025? I think the core lesson is pretty clear. Trade the tape, not the narrative.
Exactly. The market is in a valuation fatigue phase, and that liquidity vacuum tomorrow could trigger outsized swings. The bias is weak.
However, you can't ignore history. Historically, the final 2 days of the year have a 72% bullish bias?
A 72% bullish bias, the so-called Santa rally effect, and that's where the tension is. The technicals are screaming caution, but the calendar is screaming opportunity.
So the whole year-end hinges on that 6,910 wall.
It does. If the market does not clear 6,910 with conviction in the first 90 minutes tomorrow, the expectation is a drift lower. Santa stays in the workshop until 2026. But you have to recognize that if we do see a significant red start tomorrow, that 72% historical bias makes it right for a really powerful bear trap, ready to be squeezed hard in the afternoon.
So stay nimble, stay sharp.
And remember, 6,910 is the key.